Hey everyone. The stock market has been on a roller coaster lately, and it's leaving investors with one burning question. Are we officially in a bear market? If you've been watching your portfolio take a hit or just want to understand what's happening, you're in the right place. In this video, we'll break down everything you need to know about bear markets, what they are, how to identify one, and most importantly, how to protect your investments. Stick around, because this is crucial information for every investor. What is a bear market? Let's start with the basics. A bear market is when stock prices fall by 20% or more from recent highs, and investor sentiment turns overwhelmingly negative. But it's not just about the numbers. It's about the psychology behind it. Fear, uncertainty, and pessimism start to drive the market, and that's when things can get really volatile. Bear markets are different from corrections, which are shorter-term declines of 10% or more. A bear market is more severe and can last for months or even years. Historically, they've been linked to economic recessions, but not always. Sometimes they're triggered by external factors like geopolitical tensions or major policy changes. How to identify a bear market? So how do you know if we're officially in a bear market? It's not just about a single bad day or week. Here are the key signs to watch for. Sustained declines. Look at major indices like the S&P 500, NASDAQ, or Dow Jones. If they're down 20% or more from their recent peaks and the decline lasts for weeks or months, it's a strong indicator. Economic indicators, rising inflation, slowing GDP growth, or high unemployment rates can all signal trouble ahead. Investor sentiment. When fear takes over, you'll see headlines dominated by panic, investors rushing to sell, and a general sense of doom in the market. For example, during the 2008 financial crisis, the S&P 500 dropped nearly 50% over a year and a half. That was a classic bear market. Right now, if you're seeing similar patterns, it's worth paying attention. Causes of a bear market. Now let's talk about what causes a bear market. There's usually no single reason. It's often a combination of factors. Here are some common triggers. Economic slowdowns. When the economy contracts, corporate earnings drop and stock prices follow. Rising interest rates. Higher rates make borrowing more expensive, which can slow down business growth and consumer spending. Geopolitical events. Wars, trade tensions, or political instability can shake investor confidence. Market bubbles. When asset prices are inflated beyond their true value, a correction can quickly turn into a bear market. For instance, the dot-com bubble burst in 2000 led to a massive bear market as overvalued tech stocks crashed. What should you do in a bear market? Okay, so if we're in a bear market, what should you do? First, don't panic. Bear markets are a normal part of the economic cycle, and they don't last forever. Here are some strategies to help you navigate. Stay diversified. Make sure your portfolio is spread across different asset classes, sectors, and geographies. This reduces risk. Focus on quality. Look for companies with strong balance sheets, consistent earnings, and competitive advantages. These are more likely to weather the storm. Consider defensive stocks. Sectors like utilities, healthcare, and consumer staples tend to perform better during downturns because they provide essential goods and services. Avoid timing the market. Trying to predict the bottom is nearly impossible. Instead, focus on your long-term goals and stick to your investment plan. Remember, bear markets also create opportunities. Stocks are on sale, and if you have the patience and discipline, you can pick up quality investments at a discount. Historical perspective. Let's put things into perspective. Historically, bear markets have been followed by strong recoveries. For example, after the 2008 financial crisis, the S&P 500 eventually rebounded and went on to reach new all-time highs. The key is to stay calm and avoid making emotional decisions. Bear markets are tough, but they don't last forever. The average length of a bear market is about 14 months, while bull markets, periods of rising prices, can last for years. So, if you're feeling anxious right now, remember, this too shall pass. If you found this video helpful, don't forget to give it a thumbs up and share it with anyone who might be wondering about bear markets. And if you're new here, hit that subscribe button and turn on notifications so you never miss out on breaking down complex financial topics in simple ways. Thanks for watching, and I'll see you in the next video.